Welcome back to our auditing theory MCQ marathoners. We are still in the MCQ marathon playlist here at Let's Talk Audit Insurance, where we help you crack the audit code with questions for board exam preparations. And currently, we are in round three and are now approaching part three of this set of multiple choice questions for you. And as per usual, for this segment, we shall be having 25 questions, one goal, CPA success. Let's go. Question number one says the auditor has evaluated the system of internal control and has reached the conclusion that the system is well designed and is functioning as designed. So, that being said, this means that the auditor has completed the risk assessment procedures and have found the design and implementation to be promising and has therefore performed tests of controls and has also determined the operating effectiveness of the controls to be satisfactory. So, the next step for the auditor is to letter A, leave substantive testing as planned for in the audit program. Letter B, increase analytical procedures that are planned in the audit program. Letter C, remove substantive tests from the audit program. Or letter D, issue the opinion on the financial statements. If we are familiar with the trajectory of the audit process, then we would know that the auditor will perform risk assessment procedures. This performance of risk assessment procedures will give us the initial or preliminary assessment of control risk. This preliminary assessment will lead to the preliminary plans for substantive testing. However, the auditor does not stop with the preliminary assessment. If the preliminary assessment indicates that there is an intention to rely, the auditor then performs tests of controls with the hope that whatever the results of the TOC will be might be in support of the initial or preliminary assessment. So that being said, if the results of the test of controls does indicate that the initial assessment was correct, that the controls are indeed reliable, then the auditor will proceed with substantive testing as initially planned. So therefore, the answer to this one is letter A. Since the assumption here is that the test of controls yielded the same results as the preliminary assessment, then the auditor can proceed with substantive testing as planned. Of course, we know that this is not always the case. It is possible, for example, that the auditor has seen design and implementation to be promising and has therefore set preliminary assessment as less than high and endeavored or planned to have a less extensive substantive testing on the assumption that controls are good. However, when the auditor performed tests of controls, it appeared that, well, it was only at the surface level and controls didn't stand the test of controls. They were eventually found to be weak. Then what will happen is that the auditor will change the preliminary assessment from less than high to the final assessment of control risk to be high or maximum and will therefore perform extensive substantive testing. Okay, so in this case, though, the auditor is happy because the test of controls yielded a support for the preliminary assessment. So the answer is alpha. Next, which of the following statements about audit evidence is correct? So we're looking for the correct statement. Letter A says there should be a one-to-one relationship between audit objective and audit procedure, and this is not true. It is possible for there to be more than one audit objective that is being met by one audit procedure. Okay, so there doesn't have to be a one-to-one relationship. Next, sufficiency is the measure of the quality and its relevance to a particular assertion, and this is also not true because sufficiency refers to the quantity. What refers to the quality is the appropriateness. Okay, so not letter B as well. Appropriateness is the measure of quantity. No, this is wrong. So Bravo and Charlie has interchanged the correct terms. So therefore, the only answer left for us here to be the correct statement is letter D. Audit evidence is more persuasive when items of evidence from different sources or of different nature are consistent. Okay, so that's delta for this question. Moving on to the next question, which of the following is not a factor affecting the independent auditor's judgment about the quantity, type, and content of audit documentation or the working papers? So, which is not a factor? Letter A, the needs for supervision and review of the work performed by the audit assistants, such as, for example, in the case of audit teams, which are comprised mainly of junior or newbie auditors. Letter B, the expertise of the client personnel and their participation in preparing the schedules. Letter C, the type of the financial statements, schedules, or other information on which the auditor is reporting. For example, as to whether the auditor is reporting on a complete set of FS or the auditor is only reporting on an element or a single set of FS. Letter D, the nature and condition of the client's records and internal controls, looking, of course, at the level or degree of auditability of our client. So, of the four, not a factor affecting our working papers is bravo. The expertise of the client personnel and their participation in preparing the schedules is within the scope of your client's operations. This is not included as part of our consideration for our working papers. So, bravo is the answer to this one. Next, where do we report significant deficiencies in internal controls? So we know that when the auditor obtains an understanding of the client's internal controls, the auditor might chance upon certain deficiencies. And we are also reminded that in terms of material weaknesses and significant deficiencies, the auditor is required to report this. The question is to whom? Is it to letter A, the audit committee of the board of directors, letter B, the internal auditors of the client, letter C, the creditors which the client has debt to, or letter D, management of the unit in which they occurred. So we are required to report significant deficiencies and material weaknesses to the audit committee of the board of directors. So this should be alpha. Next, the following statements relate to RA 9298 or the Philippine Accountancy Act of 2004. Which statement is true? Letter A, insanity is not a ground for proceeding against a CPA. Letter A is false because insanity is a ground. Remember the grounds ICU, immoral or dishonorable conduct. We have crimes involving moral turpitude, and of course, we have unsound mind or insanity. So, letter A is false. Letter B, after 3 years, subject to certain conditions, the board may order the reinstatement of a CPA whose certificate of registration has been revoked. Letter B is also false, as the provisions of RA 9298 require not 3 years but 2 years. After 2 years, subject to certain conditions, that means it's not an automatic reinstatement. Okay, it will have to be at the discretion of the Board of Accountancy. So, not letter B. Letter C, no person shall be appointed as a member of the board unless he has been in the practice of accountancy for at least 10 years, among others. And letter C is a true statement. Please do take note that the requirement for at least 10 years experience does not favor one scope of practice. So in any scope of practice will do for as long as it is for at least 10 years. Now, what makes letter D false? It says here the Professional Regulation Commission has the authority to remove any member of the Board of Accountancy for negligence, incompetence, or any just cause. We are reminded that it is actually the President of the Philippines who appoints the members of the Board of Accountancy. And as such, it is the President who also has the authority to remove, okay, upon recommendation, of course, by the PRC. But the final removal rests in the hands of the President of the Philippines. So the true statement here is Charlie. Next, we talk about the tolerable rate of deviation. So, the tolerable rate of deviation set by the auditor for test of controls depends primarily on which of the following. Letter A, the anticipated cause of the errors. Letter B, the tolerable rate used in audits of other clients in the same industry. Or letter C, the planned risk of assessing control risk too low. Or letter D, the dollar amount of substantive misstatements. And to this, the correct answer actually is letter C. The planned risk of assessing control risk too low is also called the acceptable risk of over reliance. And if you must remember, ARO, or the acceptable risk of over reliance, is a type 2 risk. Type 2 risk being that which affects effectiveness. And again, the auditor is scared of these type 2 risks and will endeavor to control them by putting up an acceptable level. So the auditor decides on the acceptable level of over reliance, and from this decision, the auditor will then further decide on what their tolerable rate of deviation will be. So, arrow first, and then tolerable rate of deviation next. I am emphasizing this one because I think it was in round two, or was it in round one, where part two or part one of round three, where we also had a similar question relating to arrow and rate of deviation, tolerable rate of deviation. So, nonetheless, the answer to this is Charlie. Next, after consideration of a client's internal control, an auditor might decide to, letter A, increase the extent of substantive testing in areas where the controls are weak, or letter B, reduce the extent of both substantive tests and tests of controls in areas where the controls are strong, or letter C, increase the extent of substantive testing in areas where controls are strong, or letter D, reduce the extent of tests of controls in areas where the controls are strong. And to here, we got to re explore the relationship between the internal controls of the client and the auditor's substantive testing. Now, we are saying if the design and implementation appears promising, they appear strong, then the auditor will perform tests of controls on those controls that the auditor intends to rely on. After performing tests of controls, if the auditor has determined that they are indeed strong, they are indeed operating effectively, then the auditor will perform less extensive substantive testing. However, if upon testing the controls, the auditor saw that the controls are actually weak, then the auditor will perform intensive testing. So, more extensive substantive testing. Why? Because the controls are weak. So, the auditor has to compensate for the weakness in the controls by performing more substantive testing. So in this case, after consideration of a client's internal control, the auditor might decide to increase substantive testing in areas where the controls are weak. In areas where the controls are deemed strong, the auditor will perform tests of controls. And if the tests of controls show that they are strong, then the auditor will perform or reduce extensive substantive testing. So letter B is not true because letter B says reduce both substantive testing and tests of controls. In the case of letter C, if the controls are strong, we will decrease the extent of substantive testing. And letter D, when the controls are strong based on design and implementation, we will perform tests of controls, and so therefore we will increase the extent of controls testing. So the answer to this is alpha. Next, in testing for lower of cost or market, the auditor is gathering evidence to support which of the following assertions. Again, take note, the auditor is testing for LCM, or in this case, right now, it should be LCNRV. So what assertion is being tested? Is it rights and obligations? Meaning to say, will the auditor be able to see who actually owns the inventory by performing LCNRV tests? Or is it valuation? Or is it accuracy? Or is it pricing? Testing for lower of cost or market is, of course, a test for valuation. So the answer here is bravo. Let us now proceed to the next question. What is the responsibility of a successor auditor to communicate with the predecessor auditor in connection with a prospective new client? Letter A, the successor auditor should contact the predecessor auditor even if the client does not authorize contact. Or letter B, the successor auditor should obtain permission from the prospective client to contact the predecessor auditor. Or letter C, the successor auditor has no responsibility to contact the predecessor auditor. Or letter D, the successor auditor need not contact the predecessor if the successor is aware of all available relevant facts. And to this, we recall that it is actually the responsibility of the new or the successor auditor to contact the predecessor auditor, but of course, with the permission coming from the prospective client. So the answer to this is bravo. Next, in an audit of financial statements for a company, the auditor considers internal control, letter A, to the same extent as if the auditor is issuing a report on internal controls. Or letter B, in order to issue an opinion on internal controls. Or letter C, on a more limited basis than if engaged to also issue an opinion on internal controls. Or letter D, in more detail than if an opinion on internal controls is to be issued. So we are once again reminded that if we talk about an audit of financial statements, this generally requires only an opinion on the FS, not necessarily an opinion on internal controls, unless the client statement, of course, is covered by PCAOB rules in the US. Okay, but other than that, okay, the general rule is that when we audit the financial statements, we only give an opinion on the financial statements. And so, therefore, when we consider our internal control consideration between an engagement that requires us to only give an opinion on the FS versus an engagement that requires us to give an opinion on both the FS and the internal controls, then most definitely our consideration of internal controls on an external FS audit will be on a more limited basis than if engaged to also issue an opinion on internal controls. Definitely, if you are also going to issue an opinion on internal controls, then your consideration will be much more strict, right, when it comes to internal controls. So the answer to this is Charlie. Next, the auditor notices that a client's cash basis financial statements are prepared with accrual basis financial titles. This situation bears on which financial statement assertion? Is it letter A, rights and obligations, letter B, presentation and disclosure, letter C, valuation or allocation, or letter D, completeness? When the wrong financial titles are used, this is what affects presentation and disclosure. Of course, right about now, with our new categories for FS assertions, then this will be more strictly the assertion of presentation. Okay, so bravo for this number. Next, let's talk about materiality. With respect to materiality, letter A, the PSAs on planning and supervision presents a quantitative decision aid to use to calculate the dollar or peso amount. And actually, letter A is not true. Letter A is false. There is no prescribed quantitative decision matrix to use when calculating materiality. This will be left to the auditor's professional judgment after, of course, considering a variety of factors. Okay. Letter B, the preliminary estimate must be quantified. Letter C, the preliminary estimate of materiality cannot be revised during the engagement. Or letter D, the auditor considers materiality again toward the end of the engagement. So let's try to address the question, can the auditor still revise the materiality levels that they have initially set? The answer is of course, they may still revise it, especially when new circumstances or information comes to the auditor's attention. So therefore, letter C is not true. We are left with Bravo and Delta. Must materiality always be quantified? And or letter D, must materiality again be reassessed toward the end of the engagement? The correct answer here is Delta. Because while we ordinarily refer to materiality in terms of quantitative amounts, the auditor also does consider qualitative aspects. It is not only the amount, but the nature as well. So the best answer and the correct answer to this one is Delta. The auditor considers materiality again toward the end of the engagement. Next, the verification of a portion of the accounting transaction by selecting a representative sample, okay, or by the selection of a representative sample is of course called sampling. When we do not test the entire population, when we test less than 100% of the population, with of course the intention or the hope of coming up with a representative sample, what we are performing is audit sampling. So that's letter A for this number. Next question rather. The probability that an auditor's conclusion based on a sample might be different from the conclusion reached based on an audit of the entire population. What is this concept? Actually, when your decision is different because you used a sample rather than tested the entire population, this is the concept of sampling risk. In short, sampling risk is the risk born out of a non-representative sample. We do have to appreciate the fact that when the auditor makes a conclusion or a decision, this conclusion or decision is based on the sample because the auditor did not test the entire population anyway. So what the auditor is able to see is the sample. So therefore the auditor will make a conclusion based on the sample. And had the auditor tested the entire population, which the auditor did not, the auditor may actually find the results to be different. Okay, and that is the very context of sampling risk. And we are reminded for sampling risk, there are two types. There's the alpha risk or type 1 risk, and these risks affect efficiency, okay, and there is the type 2 risk, okay, or the beta risk, and these risks affect effectiveness, okay. And which one are we more scared of? Of course, beta risk. So alpha is the answer to this number or to this question. Next, each time an auditor draws a conclusion based on evidence from a sample, an additional risk called sampling risk is introduced. An example of sampling risk is, remember, sampling risk is the risk that the sample is not representative. When we say the sample is not representative, it simply means the sample does not look like the population. Okay, so let's evaluate our choices. Letter A, is sampling risk the risk born out of projecting the results of sampling beyond the population tested? Or is it properly applying an improper audit procedure to a sample data? Or is it improperly applying a proper audit procedure to a sample data? Or letter D, drawing an erroneous conclusion from the sample data? Sampling risk, of course, is letter D, right? When our conclusion is not correct, when we draw out an erroneous conclusion, and the reason being that, well, the sample that we got was not representative of the population. So this is sampling risk. Bravo and Charlie all refer to non-sampling risk. Non-sampling risks are risks which does not involve the sample. Let's say, for example, the auditor was not able to perform proper planning, the auditor was not able to choose the correct procedure, or the auditor was not able to perform, okay, the correct procedure. And so therefore that is non-sampling risk that has nothing to do with the sample. That is our non-sampling risk. So the answer to this is delta. Next, in assessing sampling risk, the risk of incorrect rejection and the risk of assessing control risk too high, or the risk of under reliance on internal accounting controls, relate to the, now remember this one, the super twins, risk of incorrect acceptance and risk of over reliance. They all refer to type 2, or that which affects effectiveness. So if we're going to take the opposite of that, the opposite of the acceptable risk of incorrect acceptance, or ARIA, is the acceptable risk of incorrect, or the risk of incorrect rejection. Okay, there is no such thing as acceptable risk of incorrect rejection. We do not try to control type 1 risks anyway. Okay, and so therefore, these are type 1 risks. What are mentioned here are type 1 risks, and they affect the efficiency of the audit. So alpha for this number. Next, a CPA examining inventory may appropriately apply sampling for attributes. Take note that we are sampling for attributes. We are sampling for characteristics in order to estimate the letter A, average price of inventory items, letter B, percentage of slow moving inventory items, letter C, dollar value of inventory, or letter D, physical quantity of the inventory items. Take note again that we are looking for characteristics, and of the four, the one which represents a characteristic or an attribute is whether the inventories are slow moving. So the answer to this is bravo. Now, this particular question would require us to evaluate two statements as to whether they are true or false. Let's look at the first statement. The auditor shall perform audit procedures designed to obtain sufficient appropriate audit evidence that all events occurring between the date of the financial statements and the date of the auditor's report. Can you picture that out? Because there seems to be, too many words. So let's repeat. You shall perform audit procedures designed to obtain sufficient and appropriate evidence that all events occurring between the date of the FS balance sheet date and the date of the auditor's report that require adjustment of or disclosure in the financial statements have been identified. The auditor is not, however, expected to perform additional audit procedures on all matters to which previously applied audit procedures have provided satisfactory conclusions. So actually, the first statement refers to our responsibility for the audit of subsequent events from balance sheet date to the auditor's report date. And according to the statement, we have to obtain sufficient and appropriate evidence within this time frame. And the first statement rather is true. Okay, that is true. We know that we will obtain sufficient and appropriate evidence from balance sheet date to the date of the auditor's report. Second statement, when the auditor identifies events that materially affect the financial statements, the auditor shall determine whether these are properly accounted for and adequately disclosed in the financial statements, which is, of course, also true. So the answer to this is alpha, true and true. Let's look at some examples of events or conditions which may individually or collectively cast significant doubt about the going concern assumption. So these events or conditions which cast significant doubt are all of the following except. So in other words, we're looking for the choice that does not cast significant doubt. Letter A, the presence of net liability or net current liability position, where the current liabilities have already outweighed the current assets, thereby putting into question the ability of the client to pay off even their current assets, right? Letter B, change from credit to cash on delivery transactions with suppliers, which actually signal or indicate that the suppliers no longer trust, the client, your client, rather to, maybe their credit rating has plummeted, so they are no longer granted in any credit facility or any credit line. So that's Bravo. Letter C, labor difficulties or shortages of important supplies. Okay, so there's no manpower or there are no supplies, shortage of supplies. Or letter D, compliance with capital or other statutory requirements. Of course, if the client is able to comply, then that shouldn't be a problem, right? So the exception here is delta. Okay, compliance with capital and other statutory requirements. Next, which of the following may an auditor least likely consider a symptom of an entity's significant going concern problems? So let's evaluate the four and let's look for the least likely a symptom of going concern issues. Letter A, there are significant recurring working capital deficiencies. So even in terms of operations, it seems like the client is already much challenged. So, letter A, I would say, may signal a going concern issue. Letter B, legal proceedings that may jeopardize the entity's ability to operate, such as, for example, the possibility of losing a franchise or the possibility of losing a permit to operate. And so, letter B is also an alert for a significant going concern problem. Letter C, a new government regulation that imposes a change in accounting principle. Let's park that to the side. Or letter D, a recurring default in meeting the entity's financial obligation. I would say letter D most definitely will also be a sign of a significant going concern problem. So therefore, least likely here should be Charlie. Let's proceed to the next question. A management representation letter would ordinarily be dated as of the letter A, date that the report is delivered to the entity audited, or is it the date of the audit report, or the balance sheet date of the latest period reported on, or the date a letter of audit inquiry is received from the entity's attorney of record? Actually, I think we all know this one. The management representation letter would be dated as of the same date as the audit report. So the answer to this is bravo. Next, what is or are the circumstances that may cause the auditor to doubt the reliability of one or more written representations? Number one, when one or more written representations are inconsistent with other audit evidence. Will that make you doubt the reliability of management's representations? I would say number one, yes. Number two, the auditor has identified significant issues related to management's commitment to competence, communication, and enforcement of integrity and ethical values, or diligence. When you are able to identify these significant issues, will you likely doubt the reliability of management's claims? The answer, of course, is also yes. So therefore, it shall be Charlie, either one or two. Next, which of the following is least likely a procedure that would be performed by the auditor near the auditor's report date? Take note that we are looking at procedures to be performed near the auditor's report date. Letter A, review, and we are looking for the least likely, by the way, let's not forget that, the least likely. Letter A, reviewing the procedures that management has established to ensure that subsequent events are identified. And letter A is yes, it is performed near the auditor's report date. And letter A does a very good job of reminding us that it is actually management who has the responsibility to ensure that subsequent events are identified. Okay. Letter B, inquiring of management as to whether any subsequent events have occurred which might affect the financial statements. Taking into consideration again, these inquiries and procedures are performed near the auditor's report date, and letter B is also true. Okay, we also perform this one in relation to our test for subsequent events. Letter C, reading the minutes of meetings of shareholders, board of directors, and audit executives held throughout the audit year. And actually, this one is the least likely because if you are performing a test for subsequent events, then the consideration should be from balance sheet date to the date of the auditor's report, not throughout the year under audit. Okay. Letter D, reading comparing the latest available interim FS, meaning to say if the audit period is for the if the year under audit is for the year ending December 31, 2023, then you will look at the latest available interim FS of 2024. And that is a usual procedure. So the least likely here is Charlie. Next, the auditor has no obligation to perform any audit procedures regarding the financial statements after the date of the auditor's report, and that is true. However, when after the date of the auditor's report, but before the date the financial statements are issued, meaning to say the auditor has already dated the report but has not yet delivered or issued the audited FS, the auditor becomes aware of a fact which may materially affect the financial statements. So even when we are no longer performing any audit procedures, but information has come to our attention, what shall the auditor do and in what particular order? Number one, determine whether management will amend. Number two, discuss the matter with management. Or number three, determine whether the FS needs amendment. So for this, we first have to discuss with management. Afterwards, determine whether the FS needs amendment. And of course, if it needs amendment, determine whether management will amend. After all, not all of these matters require amendment, right? So we first have to determine are adjustments needed? And if they are, then that's the time we will determine if management will indeed amend or adjust the financial statement. So the answer to this is letter C, 2, 3, and 1. Next, which of the following conditions or events most likely would cause an auditor to have substantial doubt about an entity's ability to continue as a going concern? Which one would most likely cause us to doubt? Okay, going concern. Letter A, cash flows from operating activities are negative. Letter B, research and development projects are postponed. Letter C, significant related party transactions are pervasive. Or letter D, stock dividends replace annual cash dividends. And actually, amongst the four, the most likely to be an indicator is letter A. When operations are no longer able to generate cash, that is a signal that the entity may be encountering some going concern challenges. Now, if we evaluate the rest of the choices, we will get to see that in the case of Bravo and Delta, where research and development projects are postponed or stock dividends replace annual cash dividends, we can see here that the business is actually trying to save up on cash. And because the business is trying to save up on cash, then this might very well improve their liquidity, okay, and will mitigate going concern issues. In the case of letter C, related party transactions are not necessarily a cause for alarm. However, we usually have a significant risk assessment or have a presumptive risk when it comes to related party transactions because of the mere fact that, well, they are related parties. We don't expect it to be an arm's length transaction. There could be some loopholes or it could be prone to abuse. We know all of these things that come with related party transactions. But at its very core, related party transactions are not necessarily bad. Okay? And when related parties chime in to maybe provide additional financial support, that might actually mitigate a going concern issue. So, letter A is the answer to this. When operations can no longer generate cash, that would signal a problem for the entity's going concern. And speaking of going concern, are you still a going concern? I hope you are still okay. I hope you still have the energy to head on over to part 4 for the continuation of the last 25 questions for round 3. But for round 3. But for now, congratulations for finishing part 3 and I hope to see all of you in round 3 part 4.